inverted yield curves is the best precursor of a slowdown and a recession that we have. In fact, the last 5 recessions were preceded with an inverted yield curve. It's also important to know that not always past performance or past inverted yield curves indicate recessions. In the last 10 plus years, we had 7 recessions, but the yield curve indicated recessions 10 times out of these 7. So not always it is 100% indicator for a recession to come. And the spread between the 2-year and the 10-year, even though now is not inverted anymore, it is still pretty much flat, 5 basis points. So it doesn't make me feel comfortable. The economy doesn't at this point indicates a recession. You don't really get a recession when retail sales, like we got last week, are growing. Consumers are making more money and spending more money. Their incomes are growing at a rate of about 3% a year right now. You don't really get a recession when unemployment is at historically all-time low, at 3.7% about. You do not get a recession when our economy, the largest in the world, $24 trillion in size almost, growing at anywhere between 2 to 3%. You do not get a recession when companies are making money. The last quarter earnings reports came out at about 6% growth year over year. That said, the world economy is slowing down. Germany is slowing down, Japan is slowing down, China is slowing down. GDP growth rate in China is less than 6%. That's not good for them. And we are, as a country, are importing some of that slowdown from other countries into our shores. We have a lot of geopolitical risks out there. They are still talking about Brexit, the UK leaving the European Union without a deal. That is going to be a disruptive effect on the world economy, no doubt about that, if it happens. We have geopolitical issues in other regions of the world, in the Middle East, Iran, Kashmir, and that also is baked into the perception that there is a slowdown. More importantly than anything, $17 trillion in debt out there. Last week we were at 16 trillion. Is now paying negative interest rates. You buy German sovereign debt and you will get nowadays a negative 0.6%. You'll buy a sovereign debt of Japan and you will get a negative 0.2% the next 10 years. And that negative interest rate is piling up and quickly. So that cannot indicate anything positive as far as the economy is outside of the US. We are no doubt the best house in a bad neighborhood because our economy is growing. And not only that, there is a tremendous scarcity of asset classes to invest. It's very difficult to go and buy negative interest rates. It's very difficult to go and buy a 30-year treasury bond that will pay you a little bit over 2% the next 30 years. It's very difficult to go and buy junk bond paper of very shaky companies that will pay you anywhere between 4 to 5%. You're not getting paid for the risk that you take. It's very uninspiring to go and buy real estate for 2 or 3% return on equity. In general, what's left are U.S. equities, in particular because there are no other places to put money to work. Therefore, it is my belief that any market decline should cause us as a firm to look for good, solid companies with pristine balance sheets, strong cash flow, companies that pay dividends, increase their dividends, buy back their own shares. And we find these companies mostly in the technology sector. Technology growth in reality is not really going to slow down because the world economy is slowing down. That has a life on its own. We are not going back as far as innovation. We are moving forward. We are storing more data in the cloud. We are not using our smartphones less. We are using them more. That fourth industrial revolution in technology is alive and kicking. And it's not going to derail so much because the world economy is slowing down. We need to be cautiously optimistic about markets. We also have the Federal Reserves in our corner. My feeling is that the Federal Reserve is going to be forced to continue cutting interest rates because we cannot have a flat yield curve / negative yield curve. Germany this morning said they might themselves create a fiscal policy whereby the government will start spending money to help their economy. China is talking about reducing their crime rates. So you have these largest world economies, Germany, China, coming to help their economies. If the president wants to be re-elected, he needs to do everything in his power to talk up the U.S. economy and help the U.S. economy. I heard over the weekend some analysts saying that some of the tariffs that we are collecting from China might be rolling back into the country in the form of tax cuts, maybe. So all these things are making me think that there is a good chance that the U.S. economy will be able to avoid a recession.
Okay, so this week I'd like to talk about a company who has an offerings coming in the next several months that we've been anticipating for quite some time. That company is Disney, and the product is Disney Plus. The reason this is interesting is that they are actually approaching this in terms of an international launch, which you don't see a lot in some of the tech sector and how they're approaching their product launches. And it's set to launch November 12th in the U.S., Canada, and then the Netherlands. And their go-to-market strategy is interesting as well, because they're taking a page out of the book of Amazon, whereas they're doing a ubiquitous launch across every single platform. Amazon has often been questioned about this, why they would launch their product, Kindle and other products, on other platforms when they're competitors. And we know Amazon's approach has always been to just get accessibility to their content on any device in any way, shape, or form. And so this will run on iOS, Apple TV, Google Chromecast, Android TV, PlayStation 4, Roku, and Xbox One. All the major platforms, even those that aren't as popular. So there'll be full integration with Apple TV. That will be the best suited platform. And the reason for that is we know that Apple and Disney have long shared a partnership from the days of Steve Jobs and his integral relationship with Pixar in getting them off the ground. So the pricing is looking like $6.99 per month in the US, or a $69.99 per year subscription. And then they also have a bundle offering between $12 and $13 for ESPN Plus, in addition to Hulu Plus, and all three of those. And that's interesting because they are taking on the form of a network of previous and conventional TV that we remember. And also, it makes them a very fair competitor to Netflix approaching it in that manner. This is something that's highly interesting to us and something that we're watching very closely.
A lot of the major headlines last week revolved around the 2-year and the 10-year inversion on the yield curve. And we talk about that pretty regularly from these meetings. Not every yield curve inversion has led to a recession. The last 5 recessions have been set off by an inverted yield curve. The typical lag from inversion to recession has averaged anywhere from 6 months to 2 years. So there is still opportunity for markets to move forward before a recession hits. And the last 5 recessions, the 6 months preceding beginning of the recession, have been very favorable in the market, where markets have performed very well the last 6 months before recession. So something we'll definitely keep an eye on. The yield curve, although it's still not currently inverted between the 2-year and the 10-year, it does remain very flat.
Hello everybody, and thank you for watching our videos. I'm Amit Stavinsky, the Managing Director of Tamar Securities and its affiliates, 911 Financial Services and Firefighters United. As always, if you like the content, become a subscriber to our YouTube channel. You can also call us directly to our main offices in Woodland Hills at 818-914-7461. The highlight of the week is that although an inverted yield curve that took place last week in our bond market more often than not indicates a slowdown or a recession to come, our U.S. economy is still the best house in a bad neighborhood.